Did you see our last video on stock market crashes? Today, we're going to finish that up in part 2. Hi, I'm Dave Lopez.
And I'm Chase Lopez, and we're investment advisor representatives with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement. So the next one we have is the global financial crisis that we experienced in 2008 going into 2009. This was in recent times, probably the most, felt the most by not only the stock market, but similar to the Great Depression, the economy as a whole very much felt this crisis.
Yeah, and if you remember, this was called, what's the other name for this one? The Great Recession.
Great Recession.
Right? So you had the Great Depression in 1929. This would have been the Great Recession. So they're saying, that was a nice way of saying, other than the Great Depression, this is as bad as it's gotten, where the whole economy, including all of the stock markets, everything went down. Real estate went down. Real estate precipitated it, didn't it?
Right.
Give me the highlights.
Yeah. So not only did the market go down, to your point, but also folks saw the value of their homes literally get destroyed over that time frame. Right. So that really is the catalyst for what happened with the economy as a whole, right? Housing is a huge part of the economy in general. So that precipitated, I think you used that word earlier, so I'm going to take it from you, precipitated that recession. So I think the S&P 500 over that time frame, in September, early December of 2008, the S&P 500 lost about 8% over that time frame. And over the entire global financial crisis, the S&P 500 lost 60% from its peak in 2008. So over basically a 2-year window, the S&P 500 lost 60%. And it took all the way until 2013 to get back to where it was. So what is that? Roughly 6 years, right, Dave? It took 6 years for you to get even after
If you didn't panic.
If you didn't panic, right? Which is a reoccurring theme of what we're talking about. If you didn't do anything, and you just held on, then it took 6 years for you to get back even. And unlike the dot-com bubble, right, where technology was hit harder, but other sectors did okay, really in the global financial crisis, everything got
much like the Great Depression of 29, everything went down.
Right. So goes to show you
a safe place.
Right. Goes to show you that different just depends on.
Now here's a great takeaway, if you don't mind me saying, for this one. This is the first time we've seen this one. Mm-hmm. I would suggest this one happened, and this is the first time we've seen what has happened ever since. The dot-com bubble burst.
Right.
And instead of just letting the economy recover. Right. Remember how we said the dot-com bubble recovered so quickly? What was it, 2 years?
Yeah,
2 years.
2 years. Mm-hmm.
I would argue that it recovered quickly because the government jumped in and artificially propped the economy up. And how did they do it after the dot-com bubble to get the economy going? The Dodd-Frank, remember the Dodd-Frank bill of mortgages, and they said, we're going to change the world with mortgages. We're going to make it easy. Anybody can qualify for a mortgage, young people with no income.
Yeah.
And they told the banks, don't worry about losing money. The government will buy these mortgages from you. So the banks could offload all their risk from bad loans to the banks. So the banks went crazy.
Right.
So the result is, the economy exploded because all of a sudden anybody could buy a house, anybody could get a loan. Right. And that was enough. It's such a big part of the economy. It fueled the rest of the economy. And the stock market took off, but it was all artificial.
Right.
And the result was the market came back. Within 2 years, you were even, but 6 years after that, 08 hit. Mm-hmm. And because you gave everybody loans, even people who had no business getting them because they couldn't repay them, then that crashed.
Yep. And I think if this is not a plug or anything, the movie, The Big Short, right, does a great job of kind of illustrating what happened over that time frame. But to your point, right, that is what they call it, the lost decade, right? You had 2000, the dot-com run up, then you had the crash, then you had up until 2007, 2008, the run up, and then the crash, and then it finally recovered, right? So basically 2000 to 2013, this is not a lot of up, a lot of down, a lot of
2013, if you had bought in 2000, and said, I'm never going to sell no matter what, 2013, you'd have basically had the same amount of money. And you would have gone through two of the biggest crashes in history, and felt kind of lucky to just not have lost a penny. You'd have been better off in that 13 years getting a 3% CD than if you had done that.
Yep.
Right. But again, I would say that volatility is a result of when the government mingles in the economy, in a free market economy, there's always consequences. And if the dot-com bubble and the following real estate implosion is a result of them working. Now, what's crazy about that is then what really caused us to get out of after 08 was more meddling by the government. They called it, that time they called it quantitative easing, which is a fancy term to say the government's just printing money and throwing it out into the economy. They call it, remember, shovel-ready jobs, they were saying? They're just creating infrastructure jobs, printing money, and that's why it's a separate video, that's why our debt's gone from $5 trillion in 2000 to $34 trillion as of the printing of this video. That's a lot of free money printing, of artificially stimulating the economy. But it caused the economy to explode after the 08 crash until the next one. Now, the next one, another unique one, and that was COVID. And we have not seen anything hit the economy like COVID, because that's the first time we've ever seen, going back 100 years, a scenario where the whole world literally shut down.
Literally stopped.
Even world wars, we were still operating our economies. But we all know we lived through that one. And that one, we had a major crash, and it happened in about 2 to 3 months. The market tanked right about February when they realized it was going to have implications. We were going to start shutting things down. The market started to crash. And COVID, we dropped on March 16th. 2020, I think, was the date. We dropped almost 3,000 points on the Dow, or about 13% crash. And then it continued to escalate as they realized things were going to continue to get worse and worse. It dropped about 34% by March 23rd. So we're 34% drop from basically February 19th, when this started, to March 23rd.
That's a month,
And then it immediately bounced back. And by August, the market was going through the roof, and we'd already recovered. So that was all the quickest drop in U.S. history, and the quickest recovery in U.S. history.
So, and the unique part about that, when we look at that compared to the other market crashes that we've seen up until this point, was, and everyone remembers, literally the economy stopped because the government told everyone to go inside, and nobody could go out and spend money or do anything. So it was the market and the economy was artificially pushed into kind of a recession, for lack of a better term, a mini recession at that time.
You can't produce money. No one's You're not going to grow.
So that's different than what we saw in the other scenarios,
And here's the big takeaway from that I got out of this one. The question really is then, why did it recover so quick? Well, it recovered so quick because the Fed came out and said, and this was their quote, "We're willing to do quantitative easing to infinity to keep the markets from imploding." Now, that's code. What that means is the government told people who understood that code, we will print money until the dollar's worthless if necessary, to keep the markets from crashing. So as soon as people who understood financial speak heard that, they jump back in the market, because there's no downside, If the federal government was not going to let the bond and the stock markets crash, no risk. And that's why we had the fastest recovery. Again, artificially
This induced. Is not a
And that's when you had, between two presidencies, $6 to $9 trillion spent in a 1 year period. Remember, I told you by 2000 we had amassed $5 trillion in debt. So in 225 years, roughly, the United States had amassed $5 trillion in debt. And this little window of a year or two and a half, we spent over $9 trillion adding to the debt, and now we're over $34 trillion. So there will be repercussions to printing money. You can't keep artificially just doubling down on giving money away to stop this. So our takeaway is did we get all of them?
I think so. That's
another recession is coming. When, Chase? What's the magic date?
I have no idea.
I don't either. We don't know. It could be next month. It could be 3 years from now. We don't know how much the government's going to stimulate the economy artificially or not stimulate it. We don't know about wars. We don't know about any of the things that are going to cause it. And if anyone tells you they do know, run.
They're not being truthful, Let's be honest.
We don't know when they're coming. So here's the big takeaway from these. 4 or 5 different major corrections, all of them very different. Different things caused them. Different things caused their recovery. right? And they affected the economy and the stock market's completely different. So what do we do?
Right.
This is the reason we're doing it.
Right. We do have solutions here, folks.
Yes.
Right? So how do you help yourself, knowing that, to Dave's point, right? Knowing that there will be another correction, knowing we don't know when the correction's happening, right? It's fair to say.
We've got 5 takeaways.
Right.
So let's just go through them together. You want to start with the first one?
Yeah. So I'll start with the first one. The first is having the right mindset. And we touched on this a little bit as we went through them, but having the right mindset, what we mean is if you have money that you're putting into the stock market, that you're investing in the stock market, you want to be comfortable, and we went through the timelines on all of these, you want to be comfortable leaving that money in there for an extended period of time, let's say 5 to 7 years, right? As we kind of went through all of those different scenarios. So you want to make sure that that money that you have in there, you are willing to leave it regardless of what happens, if we have a correction or not, regardless of what happens, you are willing to let that money sit for the long term. I think Warren Buffett has a famous saying. He says, if you're not willing to leave your if you're not willing to leave your money in the market for 10 years, then you shouldn't put your money in the market for 10 minutes, right? So it's a long-term investment, right?
Yeah. Number 2 would be if you're still saving for retirement, right?
Yep.
Continue to be committed to continue to make your savings, your contributions, whether it's your 401k or your IRA or wherever you're saving, make them regularly. And when the market crashes, do not stop making them. In fact, that's going to be the most valuable time to make them. So if a stock goes from $50 to $25, if you've got $50 to contribute and the stock's $50, you buy a share of stock. If the stock then tanks to $25 and you've put your next $50 in for the next month, now you've bought 2 shares of the stock. When that stock recovers, now you've got 3 shares of stock. Right? If the market crashes and you stop contributing, you miss the best time to buy low. But you have to have that mindset of knowing the market goes up and down. And you think of, Warren Buffett said this too, when the market goes down, he says it's a buying opportunity. When the market's down, you want to think of the stuff on sale. And the easiest way to do that, it's called dollar cost averaging, is spend the same money investing when you're saving for retirement, spend same amount every month, and don't try to time the market. Don't buy more when the market's down. Don't buy more when the market's up. Number 3 is have cash. Cash can be valuable, right? So have cash available. And by cash, I mean money that's not in the market, right? This kind of goes back to number 1. Have some cash available to use so that if the market does correct, you can allow those funds that are invested to recover. So if you have that cash, the cash is not affected by the stock market going down. You can use that for expenses that you have. So don't put all of your savings in the market. Have some cash available for anything. Yeah, this is an interesting, to be clear. So this is where we remind you that there's no one size fits all.
Yes.
Even though we say you can't time the market. This is a hedge if you're nervous because the market is up at all-time highs and you're like, look, I'm a little bit nervous. So since we can't time it, maybe you just move some money to cash to hedge your bets. Now, the disadvantage to that, if the market goes on a tear for the next 5 years and you are in your bank making 2 or 3% or maybe 5% now if you're lucky, but the market was going up 15% a year for 2 years, you lost out. You're making a bet one way or the other. So talk to your financial advisor about if it's wise to hedge a little bit. And the advantage is twofold. 1, you don't go down. But 2, imagine if the market dropped 50%, not only did you have $100,000 in cash that didn't go down, now you can get in. And if the market now just recovers, you've doubled your money. So that's a strategy. Talk to your financial advisor to see if that's appropriate for you. It's different for everybody.
Yeah, exactly. Number 4.
Number 4 is going to be, this is what we learned from the Great Depression. Do not use borrowed money in the market. Don't use margins on call or leveraging, because if the market drops 10%, and you leveraged, you might lose 100% of your assets depending on how much you've leveraged. And you cannot ever recover from that type of a loss. So that's a big one. Don't use margin calls. We recommend that. There's a place for it for professional folks who do this as a living, and they are well aware of how much money they have at risk at any one time. And even those people have enough other money. So if they bet wrong and lose it all, their life's not over. They've hedged themselves.
So I think in layman's terms, don't go to your bank and get some loan, right? And then use that loan to go buy stocks.
And that's happened in the
bust.
past.
Yeah.
Even after the Great Depression, we said people were leveraging it.
Yeah.
It happened after that.
Yeah.
Where in all of these crashes, what happened when you have, they call it exuberance, right? Irrational exuberance,
Right.
where people think you can't lose, and people will go out. You may know someone who took a second mortgage out of their
Right.
house for a cash out refinance,
Right.
and pulls $100,000 out of your house. You put it in the market at the very top.
Yeah.
The market tanks. Now you still owe that $100,000 with interest,
Right.
and your account dropped to 50.
Right.
So not just
Leave that to the
margin.
professionals.
Yeah, do not
Yeah.
be borrowing
Yeah.
money. Use only the money you've got saved in the market and money you're willing, to your point, leave 5 to 7 years.
Yep.
Last one. Since we focus on folks in or near retirement,
Mhm.
what are we saying now to people who are in retirement? They're not putting money in dollar cost average.
Right.
They're not getting a paycheck maybe, so they can just sit and wait.
Right. And I think that's the big takeaway for folks in retirement, right? Which is, you're not making those regular contributions anymore. So going back to, it kind of ties in really to all four of these, if you kind of think about it.
does, yes.
Which is, you want to make sure that any money that you're going to need in less than 5 to 7 years, right? You want to make sure that that does not have market exposure, right? And just to back up for a second, right? This is not blanket advice for everyone.
Yeah.
Really, the big takeaway is get with your financial professional to see what your specific situation requires. But big picture, right? For folks in retirement, you want to make sure that you have enough money available that would not go down in the stock market, so that if the market goes down, you have the ability to allow it to recover. Right.
Yeah. We have another pot that we can dip into that didn't drop because it has different risks.
Yeah.
Just not stock market risk. It goes back to that term of diversification.
Yep.
When we build plans for our clients, imagine 2 pots. And if they needed $5,000 and they said, Dave, if I need $5,000, which bucket am I taking out? The stuff in the market or the stuff that's not in the market, market protected?
Mm-hmm.
I go, I don't know. It depends. When we get to the year, you're going to take the $5,000. If the market's up, I might suggest you take it out of the market to sell high.
Right.
If the market's just tanked, we're going to use the same advice Chase just gave you and said, we're going to let this stuff sit as 5 to 7 years to recover. We'll take it out of the pot that didn't lose a penny.
Right.
Get with your advisor.
Yep.
If you don't have an advisor, reevaluate your portfolios.
Yep.
And look into, where am I going to take money if the market crashes for 5 to 7 years? You can do the math of how much money you need.
Right.
How can I get to those funds and let this stuff recover? And if you can't, I would suggest you want to reevaluate how much money you have at risk. Because it's not just, do you have the guts to ride out a crash? It's, do you have the financial ability to ride out a crash?
Exactly. Thanks for joining us, and we'll see you on the next video.